What is the difference between an ETF and a mutual fund? Before we answer that question, we need to first understand what a fund actually is. A fund is an investment asset that collects money from many investors into one bucket to enable themselves to buy a basket of securities. The basket of securities is made up of many different assets and allows you to get exposure to all of them by buying a portion of the fund. There are different kinds of funds, with each one focusing on a different kind of asset type. The investment strategy of combining money from a bunch of investors to track a group of assets is called an index fund, with the most common index fund tracking the S&P 500. Other examples of index funds include tracking of maybe the healthcare industry, technology industry, or the real estate industry. But in practice, index funds can follow any group of assets, and there are tons of options out there. The underlying concept of funds all have the same goal: to allow retail investors that do not have a lot of buying power to invest in a wide variety of securities that would otherwise be difficult for them to do so. For example, an investor may want to invest in all of the up-and-coming AI tech stocks right now. You may want to buy into NVIDIA, Apple, Google, Meta, and Microsoft. But that can cost a lot of money for someone who is new to investing and trying to buy into the booming AI market across all these different stocks. So instead of buying each individual stock at their full share price, which is both more expensive and tedious to manage, they buy into a fund that tracks these AI tech stocks and includes NVIDIA, Apple, Google, Meta, and Microsoft in it. This allows the investor, along with a bunch of other investors, to pull their money together to have enough money to buy into each one of the stocks in the sector in one consolidated fund. A fund can either be passively or actively managed. What is a passively managed fund? Let's understand what a passively managed fund is by looking at our AI tech fund example. Our basket of goods is determined to follow the top 5 AI tech stocks that lead the market in market cap. The fund will change the 5 stocks solely depending on this rule, that if a stock is in the AI sector and is in the top 5 in market capitalization, then it will be included in our fund. Currently, NVIDIA, Apple, Google, Meta, and Microsoft are the 5 stocks that fit our rule criteria and are included in our fund. While these 5 may be the largest now, what if in 3 years there is a new stock that overtakes NVIDIA as the leading provider of GPUs and in market cap? Should this AI tech stock fund just continue holding NVIDIA since it used to be the best stock on the market? Or should the fund wait for NVIDIA to rebound and keep them in the fund? The answer is clear. As a passively managed fund, NVIDIA would be automatically taken out of the fund and replaced with the emerging stock. The key in a passively managed fund is that it completely takes out any human decision-making or judgment calls. Passively managed funds simply construct their basket of securities depending on a defined set of rules. Now, let us look at an actively managed fund. When it is an actively managed fund, there are people called fund managers that make decisions for the fund. They are responsible for constantly monitoring and analyzing the AI tech market. They would be doing deep research on emerging trends in AI, understanding the financials of many different stocks, and making judgment calls on what the top 5 AI stocks are to generate high returns for their investors. So, back to the example again. The active fund's 5 stocks could look different. Say an active manager foresaw the downfall of NVIDIA and replaced them with the new up-and-comer in the AI space. The fund manager was able to buy the emerging stock when it was extremely cheap, and therefore got amazing returns because of their analysis. On the flip side, the emerging stock could have had a bad earnings report and sank in stock price, resulting in a big loss. It is a risk that investors are willing to take with actively managed funds because they believe the potential high returns that actively managed funds offer offset the higher risk. Additionally, actively managed funds charge their investors high fees because of the hard work fund managers do trying to beat the market, while passively managed funds have extremely low fees. So to summarize, a passive fund is created using a rule-based tracking strategy that tries to match the market and achieve moderate returns, with less risk typically associated. An active fund is created using human analysis and decision-making in an attempt to beat the market and have very high returns, with more risk involved. It is a controversial topic whether passively managed or actively managed funds are more effective for investors, largely driven by the management fees that actively managed funds have that passively managed funds do not have. So now that we have some background, what actually is the difference between an ETF and a mutual fund? Starting with an ETF. An ETF is an index fund that is typically passively managed. An ETF is traded the same way a stock would be traded. It can be bought and sold throughout the day, and its price is constantly fluctuating depending on the buying and selling volumes between traders. A mutual fund is an index fund that is typically actively managed. Unlike an ETF, it is only priced once a day, which is typically at 4 p.m. The mutual fund is priced based on its net asset value, or NAV for short. The net asset value is calculated by taking the total amount of money that all the investors are able to pull together into the fund portfolio, minus any liabilities the fund has, which can be things like management fees because it's an actively managed fund, taxes, etc., divided by the number of shares outstanding, put more simply, is the total number of all the different people that own shares of the mutual fund. So let's zoom out and look at this Venn diagram to summarize our understanding. ETFs and mutual funds have a lot of overlapping qualities, but do have differences as well. ETFs and mutual funds are both a type of index fund, which is the investment strategy of tracking a specific basket of securities. They are both comprised of many investors pulling their money together to enable themselves to buy into lots of different assets. The difference in an ETF is that it is commonly passively managed, and the basket of securities is put together by a specific set of rules. It is also priced and traded throughout the day, similar to a stock, and is associated with lower risk and more moderate returns. There are extremely low fees associated with ETFs, sometimes no fees at all. A mutual fund is commonly actively managed, with portfolio managers manage the fund and complete analysis and make judgment decisions to pick the best stocks for its basket of securities. Its price is calculated once a day by using the net asset value of the mutual fund and is associated with higher risk, but higher potential returns. There are high fees associated with a mutual fund.